The ornate halls of the Bank of England will be filled with furrowed brows and intense debate this week, as the 9 solemn members of the Monetary Policy Committee convene to decide the fate of British interest rates. It's a monumental decision, one that could shape the trajectory of the nation's economic future in profound ways. For nearly a year now, borrowing costs in the UK have been stuck at 5.25%, a staggering 16-year high. Like a millstone around the neck of the economy, these punishingly elevated rates have threatened to strangle the delicate green shoots of recovery that had tentatively begun to emerge from the shallow recession of 2022. The wheels of commerce have grown heavy and leaden under the weight of such expensive money. Businesses have husbanded their capital, investment has stagnated, and the invisible hand of the market has gone somewhat limp and lethargic in its movements. But now, there are faint glimmers of hope on the horizon. A consensus has begun to crystallize among analysts and investors that the great era of skyrocketing prices may finally be drawing to a close. The scorching inflationary bonfires that raged across the land, fueled by pandemic-era supply shocks and loose money, appear to be damping down at last. As this great fever breaks, policymakers at the Old Lady of Threadneedle Street are gingerly considering administering the fiscal equivalents of cool compresses and sips of broth to help nurse the patient, the UK economy, back to full health. Specifically, they may finally decide to lower interest rates for the first time since COVID upended our world. The betting markets are leaning towards a quarter-point cut when the MPC announces its decision at noon on Thursday in London, with investors currently giving roughly 57% odds to such a move. A slim majority of economists surveyed also foresee the dropping of the benchmark rate down to 5%. If the hawks do indeed loosen their talons this week, it would mark a pivotal turning point in UK monetary policy after a long cycle of serial rate hikes stretching back to late 2021. Ever since annual inflation breached the 2% target and went soaring towards double digits, the bank has been aggressively tightening to wrestle that raging price bull to the ground. But at long last, the latest data seem to signal that this unflinching inflation fighter has finally broken its foe. UK CPI has dropped back to precisely 2% as of June, smack on the bullseye set forth in the bank's policy mandate. The broader dynamic suggests that broader inflationary pressures are abating across the board. Service sector inflation, which had been stubbornly persisting at elevated levels, suddenly cooled in June's numbers. True, accommodation costs did spike due to the frenzy around Taylor Swift's wildly popular tour. But strip out those hotel nights and look at more stable underlying gauges, and it's clear that the sizzling price pressures in this key services sphere have been allowed to vent at last. The runaway wage growth threatening a worrying wage price spiral also looks to be leveling off, according to surveys of firms. With the labor force no longer quite as tight, employers are rolling back their frantic efforts to bid up compensation packages. Financial markets have taken notice too, with traders steadily paring back their expectations for how high interest rates will need to rise to tame inflation over the past 6 months. The long-term equilibrium for the policy rate implied by market pricing has dropped from around 6.25% to the 5% area. While such feverish bouts of viral price pressures often prove difficult to completely extinguish, with pockets of sticky areas persisting longer than expected, all the emerging evidence points to a decisive turn in the tide. It's this decisive inflection point in the data that has seemingly swayed the hitherto hawkish MPC doves towards joining the I camp and voting for some modest monetary easing at this meeting. Crucially, it now appears that Andrew Bailey himself, the Chancellor of this monetary Excalibur, will finally break his lengthy silence on policy matters by voting for a cut. The wizened governor has warily held his tongue in recent months, refusing to sway the debate over whether to hike, hold or cut while Britain was enmeshed in the hurly-burly of a hard-fought general election campaign. But with that political fracas now behind them after Keir Starmer's Labour Party swept to power on July 4th, Bailey can set aside such strategic circumspection. And the latest meeting minutes suggest his dovish tendencies are resurfacing, revealing that he was among the 3 MPC members who saw June's decision to hold rates as a finely balanced call. His first major speech in months, scheduled for 12:30 p.m. directly after the rates verdict on Thursday, will be his opening salvo in setting the tone for this new policy cycle. Market watchers will be listening intently for any hints about how rapidly the governor feels rates can be nudged lower from here if disinflation keeps unfolding as expected. Bailey's comments will be scrutinized alongside the quarterly economic projections the bank will release concomitantly. These forecasts will give a vital steer on just how severe the MPC judges any remaining lingering economic slack and inflationary impulses to be. Analysts at Deutsche Bank believe the growth outlook is set for a substantial upgrade, perhaps a big one in their words. They see the bank revising up its 2024 GDP forecasts markedly to reflect the startling recent momentum evident in household spending and capital investment metrics. The British economy has staged an impressive recovery and re-acceleration over the past 6 months, consistently topping even the most bullish predictions. Resurging confidence has consumers freely opening their wallets, while corporations are finally dusting off long-deferred spending plans and deploying some of their lockdown-era cash hoards. However, this very resurgence in aggregate demand raises some thorny questions for the monetary gurus pondering their next move. If real output is rapidly regaining its pre-COVID cruising speed, then how much longer can substantial economic slack or spare capacity really remain to cap pricing pressures organically? Some, like economists at ING, suspect the bank will still see ample room to run before bottleneck risks reemerge. This more dovish baseline view would imply scope for a couple more rate cuts after this week's likely move, should the inflation outlook remain benign. According to ING's James Smith, others like Deutsche's Sanjay Raja see less tolerance for a continued rapid rebound without stoking inflationary overheating risks. They suspect the bank's suite of models may flag diminishing economic slack to comfortably accommodate much more growth acceleration from here. This would, in turn, imply less room for aggressive easing. But even among those anticipating a more hawkish set of new forecasts, most see the MPC's first order of business being to validate market pricing for lower rates through 2023. A 25 BP cut to 5% is anticipated to be just an opening maneuver in an easing cycle that brings the policy rate comfortably back below 4.5% by year-end at a minimum. Ultimately, the path for rates will depend on those periodic pivots in rhetoric and forecasts much more than any single decision this week. It will be critical to gauge whether Bailey and company still ascribe to the orthodox academic view that monetary policy operates with long and variable lags requiring preemptive easing. Some observers wonder if the governor and his colleagues on the committee have been sobered and schooled by their recent failed attempts to get ahead of inflation's cyclical turn. If so, they may opt for brisker easing up front to avoid a perilous replay of being continually behind the curve. While the policy verdict itself this week is important, the language and forward guidance around it will be even more critical for handicapping how quickly the central bank's foot comes off the policy brakes. Will Bailey reiterate the explicit conditional commitment to further cuts if disinflation broadly tracks projections, effectively putting easing on autopilot? Or will he reset with more circumspect, data-dependent messaging, leaving more optionality to raise or lower rates depending on the evolving picture? Seasoned bank watchers know the governor loves to salt his rhetoric with sporting metaphors, often likening monetary maneuvers to everything from cricket to rugby. So observers may be treated to Bailey waxing poetic about delicately recalibrating the bank's policy stance, finessing its way down from the tightest settings in decades gradually yet preemptively. But others may detect a more hawkish undertone emerging at this pivotal inflection point. Perhaps Bailey will liken the challenge to a slippery slope that must be carefully navigated. Too much accommodation too quickly risks sending inflation spinning out of control once again, just as it has finally been subdued. For all the public fascination with forecasting the MPC's next modest rate adjustment, astute observers know the larger saga unfolding is around the bank's ambitions to not just pause rate hikes, but actively unwind them over time. It has signaled repeatedly since February that an eventual pivot to easing is very much on its radar as the disinflationary dynamics become entrenched. Alongside contemplating that strategic rate cut trajectory, the Monetary Policy Committee must also formulate plans for gradually paring their gargantuan £875 billion portfolio of government bonds and other assets accumulated through years of quantitative easing. This process of quantitative tightening, QT, effective drains liquidity from the financial plumbing and acts as an additional contractionary force beyond just lifting the policy rate. The MPC's current QT runoff settings have it draining £10 billion per quarter by allowing maturing gilts to roll off its balance sheet untouched. At that measured pace, it would take the better part of 2 decades to completely unwind their pandemic-era asset stockpile. So far, the bank has given no indications it intends to deviate from this glacial return to a more normalized policy stance and balance sheet footprint. But there's an open question as to whether the committee may start hinting at ambitions to shift towards a higher top gear for their QT driving. Some economists reckon the bank may opt to keep the QT throttle set to its current £100 billion annual pace for the foreseeable future. However, Others like the rates team at RBC Capital Markets see mounting pressure to accelerate that cadence over time as rate cuts materialize. According to RBC's calculations, maintaining the present QD settings alongside 525 basis point rate cuts would see the bank's overall policy stance remaining looser than current levels deep into 2024. Given how adamant policymakers have been about needing to reset overall monetary settings to a restrictive posture, RBC sees them ultimately making quicker inroads into shrinking their bloated bond hoard. Unveiling plans for more aggressive QD need not take place at this week's meeting, RBC's analysts emphasize. We may simply get a brief boilerplate reference to the program continuing to run unaltered, with more substantive recalibrations communicated in September's annual strategy review. But any whiff of an inclination to turn up the spigot on liquidity drainage in future could prove a hawkish counterbalance, offsetting some of the immediate market excitement over prospective rate cuts. In the extraordinary times plaguing Britain's economy, one form of easing may merely give way to another form of tightening. The dueling tensions of sticky inflationary inertia and rising slack distilling this high-stakes policy decision point to the crux of why calibrating monetary policy remains as much an art as a science. Even with the full might of matrixed modeling and quantitative firepower, the MPC resides in that murky middle ground of finely balanced judgment calls and irreducible uncertainty. It's a far cry from those heady days of summer 2021, when the bank's own analysis confidently proclaimed the UK economy was primed for a period of modest disciplined tightening over the next 3 years. How quickly those neatly penciled forecasts dissolved into the subsequent inflationary bonfire that roared for over a year, scattering monetary policymakers and tossing their rate plans onto the blazing pyre. Perhaps the most fateful decision confronting Bailey and company is whether to view the current eerie stillness in consumer prices as a tenuous lull in the gathering storm, or the ushering in of a prevailing disinflationary breeze. Tussling with that elemental enigma will form the crux of Thursday's high drama on Threadneedle Street. For in grappling with that cyclical quandary lies the power to either hasten or postpone the economic revival that Britain so desperately craves after a dreary decade of muddling mediocrity. If the MPC majority leans too aggressively toward easing at this juncture, they risk reawakening the inflation demon just as it had been chained. An overly accommodative monetary stance could inject fresh accelerant into a labor market already running hot and tight, where wage costs are still spiraling upwards at a concerning clip above 7%. Unleash too much fresh spending power into a demand-constrained economy still struggling with supply bottlenecks and input shortages, and the inflationary temperature could spike in short order as soon as 2024. The bank's mantra of securing price stability could end up severely tested mere quarters after patting itself on the back for conquering double-digit CPI surges. But shift prematurely toward outright policy restraint and risk strangling the UK's nascent recovery in its crib. After years stuck in stagnant purgatory slogging through productivity scars, perhaps this awakening capex and consumption cycle could finally catalyze a desperately needed bout of overall economic rejuvenation. Hastening its demise through overly prudish policymaking could relegate Britain to secular malaise. Such are the Sisyphean travails facing our modern monetary priesthood. For all their professorial pretenses toward mathematical precision, their fated decisions are invariably shrouded in capricious fog. Choose prudence and risk constricting recovery. Opt for daring and the inflationary wildfire reprises. In the end, the best Bailey and his cohorts can do is stay rooted in the latest flow of objective evidence rather than entombed in preconceived dogmas or frameworks. They must honor the core Baconian tenet to continually revise judgment in the light of shifting empirical realities. That means an acute sensitivity to nuanced inflection points across the scattershot inflationary dashboards and activity barometers. Signals like plateauing wage dynamics in service businesses and tentative transport cost reprieves that may finally be quelling that fateful second-round inflationary impulse. Glimmers like the steadily receding long-term market pricing for monetary restraint over the policy horizon. Yet those encouraging early signs must be offset against the considerable lags and inertia embedded in core inflationary drivers like shelter costs. While housing price inflation has crested, it will manifest in higher rent gauges for some time yet. And labor shortage pressures continue to fester, with the UK workforce participation rate still well off pre-COVID levels. In their heart of hearts, the MPC members may simply wish to exercise some humble Burkean caution, to navigate a steady, non-disruptive middle course, neither swinging the economy toward fresh imbalances, nor harshly arresting its green shoots. Primum non nocere, first, do no harm. Perhaps that prudent moderating impulse ultimately carries the day and precludes any bolder gambit like a larger-than-expected 50 basis point cut. The old lady may simply opt to dip her toe gingerly back in the waters of accommodation after a marathon tightening cycle, assessing the temperature cautiously before wading in further. Ever the pragmatists, Bailey and his bank staffers know the great wheel of the economic cycle turns ceaselessly. A stint of incrementally descending rates now may simply presage a need to reverse course and retighten before too long as the next cyclical inflation pulse inevitably drums up. As constants in this ever-gyrating spiral of cool and feverish, their onus is to shepherd the British macroeconomy around its maddening revolutions as stably as possible. So when the MPC breaks its brief silence just after noon this Thursday, minds must be primed for neither bombastic pivots nor dramatic resets to the policy paradigm. Theirs will likely be a finely balanced recalibration communicated through undertones and inflections, a steadying rudder shift calibrated with the precision of a sailor tacking incrementally between squalls scattered across any horizon. The august language may cloak decisions of real consequence in patanas of prudence. But those runic passages will be parsed and their implications extrapolated out to the market's most extreme frontiers and capillary ends. For in these delicate maneuvers lies the weight of so much promise and peril. Whether Britain rekindles its long stagnant productivity fires and vaults toward escape velocity after this interminably dreary period of sclerotic malaise, or whether instead, the nation's frustrated economic rebirth remains indefinitely stillborn, stymied by the policy fumbles of the impresarios who so confidently choreograph its every ebb and flow. For all their modeling sophistry and analytical exertions, the 9 gathered savants of Threadneedle Street cannot truly divine the immense microeconomic cosmos their levers calibrate. Theirs is an eternal struggle between conquering the invisible through mathematical abstractions and remaining umbilically tied to the infinite complexities of a real world too vast to fully systematize. In bowing to that inescapable uncertainty, the MPC's language may strive for a muddied ambiguity, a non-committal ambivalence seemingly incommensurate with the historic weight of their charge. But therein lies the difficult nuance of this secular art. For each easing cycle and pivot ultimately stems not from some incontrovertible deductive proof, but from the gradual accretion of perspicacity amongst reasonable people of goodwill honoring the same ambiguous factual contours. Crystallizing such a convergence of perspectives from amidst a blur of incomplete data points veering between stasis and motion is the truest test of judgment at the heights of influence. So often the economic forecaster's solemn vocation devolves into merely discerning the faintest inklings of the blindingly obvious only evident to the layperson months or years too late. To elevate these endeavors into an undertaking of profound societal consequence is to indulge the grandest pretensions imaginable. And yet their every semi-annual rumination echoes in the lives of millions, the monthly mortgage outlay of families refinancing in the outer boroughs, the strained budgets of rural businesses, the projected return shortfalls of pension funds from Cumbria to Cornwall. Watch closely indeed as the Monetary Policy Committee plots the coordinated movements of their fabled blunt instruments this week. But gaze even more attentively upon those rhetorical penumbras surrounding their headline act, that misty ether of economic forecasting whence all action flows. For it is there that the true soul of central banking resides, a realm too often obscured from view by thickets of academic jargon, bafflingly abstract quantitative methodologies, and endless reams of spaghetti-plotted charts from inscrutable logistics models and DSG frameworks. Strip away those arid algebraic accoutrements, however, and one bears witness to an ages-old tradition as primordial as it is elevated, of elders and sages congregated to divine the future flowering of crops and finances, harvests and yields, feast and famine, of rendering judgment through systems both fiendishly complex yet profoundly self-evident, transmuting arcane rituals and mystic numerology into a seamless continuity with the most humble human experiences. Just as prehistoric priests consulted the motions of heavenly spheres to discern seasonal portents, so too do the lavishly credentialed astronomer-economists of modernity monitor the gravitational forces exerted by vast macroeconomic planets like employment, inflation, consumption, and output upon one another. Just as the astrological shamans of yore festooned their temples with charts and prognostic diagrams to beguile and intimidate the credulous, so too do their PhD-wielding counterparts daunt the public with dense analytical compendia and Byzantine flow charts, fetishizing the obscure to legitimize their exalted ranks. These motifs perpetually recur because for all the evolutions of mathematics and econometric techniques over the ages, the metaphysical nucleus of central banking ultimately refracts back to these ancient and primordial roots. to speculate on the confluence of misty earthly and celestial variables and discern fateful repercussions for the human experience amid the shifting economic tides, to divine the precise moments for aggressive stimulus or restraint from the patterns swirling through the heavens. And when Bailey and Company published their updated growth and inflation projections on Thursday, the MPC merely reprises that most archaic custom of the high priests, the awestruck ritual unfurling of some transcendent cosmological power's newest astrological chart and proclaiming its associated omens for the madding crowd's yearning for meaning. Ultimately, this centuries-recurring tradition in all its solemn grandeur amounts to little more than institutionalizing society's eternal anxieties surrounding the fickle oscillations of the human condition between security and deprivation, fortune and misery. Through prophets' prognostications, we barter portions of our peace of mind against cosmic angst. So as the assembled regents of the old lady retreat into their hermeticum to pore over the latest druidic auguries and ineffable signs, the British public must ask themselves how heavily to psychologically invest in this immemorial routine. How credulous should we be to the bold charting of looming economic events, or skeptical that our fates will inevitably outrun such rigid determinism? How much discomfort must we preemptively integrate into our plans from the next pivot? After all, the scorched legacies of the previous year's ruinous recession, runaway inflation, and political turmoil still smolder so freshly in the cultural consciousness. Those widely panned clairvoyant forecasts which so utterly missed the gathering storm now linger as darkly cautionary artifacts behind the bank's grand facade. If the MPC can stumble so badly on the fundamental challenge of simply forecasting existing conditions in an accurate, timely manner, we might reasonably wonder what value to ascribe their calculations divining alternate entire hypothetical futures for us 12 months hence. Especially when core economic relationships and regularities seem to fracture with each passing crisis. Perhaps the proper perspective is heeding central bank shifts not as prophecy but mere navigational tripwires, signals to rebalance exposures, buffer cash reserves, restructure debts, and implement contingencies, not aiming for perfect foresight, but simply striving to stay centered amidst the maelstrom's unpredictable gyrations. Or perhaps that gradualist ambition still flatters the forecasting class too generously, mistaking their painstaking labor for systematized insight rather than systematized cluelessness. Maybe the honest admission is that for all their exertions, the great reconvening bank seers can do little but collectively uphold the thinnest veneer of institutional control over economic events already careening far beyond reach. So they find themselves propelled by this week's proceedings into donning the threadbare habiliments of the old Delphic oracles, shoring up societal faith by cloaking the caprices of blind external forces in the theater of enlightened monetary management, shrouding mere reactive contingency planning in the garb of transcendent mastery over the universal order and rhythm of things. We moderns so often flatter ourselves that our age has outgrown such Neolithic mysticism, our potent intellects and complex informatic computer models having levered us wholly free from the dark womb of primordial superstitions. With each dismal forecasting failure indulged from on high, however, the public's confidence slowly drains that these secular divinities truly command deeper insight than some random roll of the zodiacal bones. Perhaps that inexorable wane in credibility and public thrust helps explain why it becomes ever more imperative with each ceremonial interest rate adjustment for the gathered MPC elders to embellish their communications with grandiloquent rhetorical flourishes and gravitic verbal pommery. No mere shifting of basis points can suffice. The discursive preamble must be larded with grandiose, indecipherably discursive invocations to evolving reaction functions and the highwaying of skewed risk distributions. Consultations undertaken through enhanced analytical frameworks that layer in real-time informative signals beyond those incorporated into baseline projections. Arcana is piled upon impenetrable arcana until the obfuscating jargon completely encrusts the animating kernel of mundane reality like some fractal plastering of sedimentary accretions. Through such obscuring arabesques, the great ritual mummification of economic policymaking composts itself ever grander. At the apex, figures like Bailey himself begin transmogrifying into the loftiest of hierophants and hierogrammatists, exalted logothetes fluent in the sacred mathematical speech requisite to midwife events into fruition through sheer celebratory mimesis of oracular ceremony. No longer mere stewards of interest rate policy, but Gnostic initiate grappling with the dialectics of our being and non-being. It's only by elevating the discourse to such parodic heights of metaphysical grandeur that central bankers can sustain the vital religion of public credibility which fuels their authority. For woven inextricably into this most hallowed of monetary tightenings or easings is a simultaneous ritual performance of legitimization, a cyclical refounding of that transcendental social covenant ceding economic augury to this secular priestly caste. Indeed, such is the indispensable role of central banking's high liturgists across the ages, not merely implementers of mechanistic interest rate policies, but ceremonial reciters of the monetary order from out of primordial chaos. Theirs is a perpendicular vocation intersecting the finite and infinite, synchronizing the particular adjustments announced on any given Thursday with the metaphysical abstractions grounding our very comprehension of value itself. For what intrinsically separates mere numbers like 5% or 4.75% from cosmic insignificance, if not the hallowed investiture of that all-important basis point with synchronous symbolic and existential resonance? It requires the central mythography, the perpetually renewed allegory and storytelling emanating from the gilded podiums of Threadneedle Street, the Eccles Building, and all foreign whats of the pecuniary Sangha. Only through that incessant mythopoeic oral tradition reverberating across the ages from the bankers' temples and relic sites can an inert policy rate status quo coagulate richer dimensionality as either harbinger of growth and abundance, or draconian prelude to austerity and pestilence. A severing of that narration, that mystic continuum pulsing behind the rate's numerical cipher, would render it desiccated, null, and devoid of potency. Little wonder then that Bailey and company must continually regenerate and revivify that old metaphysical poetry through the perpetual refreshing of ritual. Their task is nothing less than re-ceremonially constituting the sacred idea of value from out of the desiccated husks of foregone mathematical abstractions. Breathing anew the civilizational dream of hard-won Britannic economic grandeur into dilapidated homunculi like interest rates, inflation targets, debt issuances, and transmission mechanisms. Thursday's rites will rehearse this immemorial cycle anew, whether the gathered MPC brothers intend it or not. Shrouded in the outer vestments of sober data analysis and quantitative policy formulation, their essential soteriological errand remains a deeper striving toward metaphysical reconstitution of society's unifying macroeconomic totems. In this light, their vote on interest rates is ultimately an almost incidental pretext, a mere liturgical armature upholding something far more transcendent and momentous. For looming behind those decimal point adjustments echoing across Reuters terminals is the larger cosmic reorientation of the shared mythological imaginary toward which all economic civilization naturally philosophers. Will the updated projections and policy guidance chant in the language of revitalized expansion and renaissance, of a reinvigorated economic cycle restoring motion to the stagnant waters? Or will they instead voice the overwritten harmonics of new restraint and world historical inflection, an epic initiation of long-gathering malaise finally ceding to melancholic denouement? Those are the true stakes at play in this week's recrudescent ceremonial of financial transfiguration. Whether the MPC sibyls intone the auspices for resurgent growth, green shoots, and plenteousness, or if instead their auguries limn the curdling contractions of scarcity, retrenchment, and impending socio-economic decline. On the surface level, we debate trivial policy adjustments and macroeconomic calibration, but peering beyond these incantatory veils reveals the raw cosmogony and teleological speculation at the ritual's pulsing heart. At base, we argue our perpetual cycles of renewal and decay, continually reenacting through stagecraft the larger metaphysical drama of civilizational ascent versus entropy and material devolution. Through such mythopoeic lenses, Bailey's rhetorical cauteries and Delphic ambages coalesce into something grander than mere symbolic messaging aimed at shaping market expectations and data-dependent forward guidance. They become the paragonic gestures of an initiated seer fluently rehearsing those subtle cosmological movements requisite to steer society's collective semiosis and temporality, modulating the entire socius between valorized eons of dynamism and reviled epochs of socio-economic sclerosis through numinous sleight of tongue and dark arts of central banking ventriloquism. Should these dialectical reflections still risk striking too rarefied, too phantasmagorically abstract an elevation for the humble topic of interest rate adjustments? Well, perhaps that's the disciplinary point. For one could argue such diaphanous circumlocutions and grotesque excesses of magniloquence are indispensable rhetorical strategies through which central banking regenerates its own social authority and prestige. Like all quasi-mystical power centers saddled with husbanding society's holiest myths, the monetary cult cannot afford to continually demystify and desacralize its own solemn offices in the coarse vernacular of the profane. To do so, to collapse those inflated claims to cosmic grandeur and pretensions to metaphysical profundity, would be to risk strangling the very life source fueling their institutional legitimacy. So we find ourselves coursing amidst the Baroque proliferation of mystificatory discourses, oracular blurrings, and cosmogonic feats of world calligraphy through which this latter-day economic priesthood transcendentally bootstraps itself into ritualized indispensability. The avalanches of high doxological theory merely camouflage the quotidian custodianship of an aging, inscrutable edifice, the worshipful edifice of monetary civilization itself. Only by perpetually exalting their hermetic procedures in such grandiloquent allegories can the elders and sophists gathered at august sites like the bank retain their aura of hieratic mastery and reinforce their civic coronation as the very apotheosis of economic reason and macroprudential foresight. Each fresh policy pronouncement thus ritualistically apocryphizes a new addition to the vast central banking mythology gradually supersaturating our social imaginary over decades, intricately synchronizing the sacred archetypes of boom and bust, inflation and moderation, fecundity and drought into colossal overwritten symbolic calendars, veritable Mayan codices of metaphysical economic drama. Each fresh tale joins the accumulated recensions as another richly embroidered illustrated panel within the Church of High Finance's infinite cosmological tapestry. So while we may be tempted this Thursday to merely deconstruct Bailey's oracular pronouncements as the prosaic technical adjustments of some dismal policy machinery, we'd be coached to resist that pedestrian reflex. Instead, recognize the true heraldic drama and mythopoetic splendor of the bank recrudescently regenerating its own esoteric metaphysics on our behalf. Not the mere cloistered shifting of interest rates, however momentous those numerological adjustments may reverberate. No, something grander altogether, a fully liturgized refounding of the very economic cosmos itself, a metaphysical cataclysm and metaphorization of monetary being itself through ceremonial crisis and inceptual hypostasis. For in that periodic reconfiguration and rebirth of the economic order through oratorical thaumaturgy lies the vital social function of central banking as our era's paradigmatic cult, a primeval spiritual engine cyclically rebooting the ritual technologies through which we constantly renovate our cosmological relationship to invisible value-attaining phenomenal inscription. Or in other words, a pretty big deal happening this Thursday at their little noontime gathering.